Ugly stock market? What comes next? In the video last week, I thought there might be some hope for an improving stock market once the CPI came out and tax loss selling subsided. Well, the Fed discussion on Wednesday scared the markets with a commitment to raise the target rate from 4.6% to 5.1% by the end of next year. This clearly spooked the stock and bond markets, which continued to fall after rising for a couple of days. Let's take a look at the market action over the past week and some longer time frames to get a sense of perspective of what's going on here. As you can see from the graph of these indices over the past week, we had a nice rally here after the CPI number came out and then the Fed talked, and you can see what happened. And by the end of the week, Ark was at the bottom, NASDAQ and small caps were kind of in the middle there. You can barely tell because they're all so close together, and the Dow was the best performing sector. This is an unhealthy stock market for last week. What about over the last month? Well, you can see over the past month, Ark is down the most. Small caps are down second, NASDAQ third, S&P fourth, and Dow is the best performing index over the past month. Again, unhealthy stock market. Not just the fact that they're all down, but the riskier equities are down more than the Dow, which are the safer equities. What about over the last 6 months? Well, you can see here, we reached a bottom back here, and the Dow and the small caps led the way out, but now everything is falling. And Ark is the lowest, NASDAQ second, small caps and SPY third. And again, Dow are the best performing stocks of all of these, which again is not a healthy way to come off of a bottom. Now for some real perspective, let's take a look going back 5 years. If we look back 5 years, the NASDAQ was the best performing index, up 74.27%. The S&P was the second best performing index, up 43.27%. The Russell 2000 small caps really didn't perform that well over a 5-year period, up 13.83%. And Ark Innovation, you can buy it at a 12% discount from where it was selling 5 years ago. This is crazy. How do the market dynamics look? I've plotted the performance of SPY, or the S&P 500, in the black line, although these metrics that we're calculating here don't really have much to do with the index, but they give you a good indication of what's going on in the markets. So the blue line is a bottom confirmation indicator. The orange line is a bottom forming indicator. The dashed line is the confidence level. So how confident are you that we have a bottom forming or a bottom confirmation? And again, the black line is the growth of SPY. So what is this currently telling us? Well, several weeks ago, back in September, we actually had 2 bottom forming indications that are off the chart here. Then that was followed at the end of October by a fairly strong bottom confirmation, where the bottom confirmation level was at 100% and the confidence level was in the mid to high 90% range. This is a very good bottom confirmation. We had another try at a bottom confirmation here that failed. Confidence level never got there. Another one here that looked like it was heading the right way. It failed. And now we have potentially a new bottom forming indicator here. Now, this could take a while to play out, so it doesn't mean we've seen the bottom. We could have a ways to go here. Let's take a look at the equity versus safety rankings. These are very telling in the shorter term. So I always go back to August 17th. We had a very healthy stock market, but we had a very unhealthy treasury market. You can see longer duration treasuries, TLT and EDV, were ranked dead last, 9 and 10, while the riskier equities, small caps and NASDAQ, were ranked 1 and 2. So this is a healthy equity market, unhealthy treasury market. Then by September 30th, we had an unhealthy equity market, but still an unhealthy treasury market. Then by December 2nd, we had a healthy treasury market. Now the longer duration treasuries are ranked 1 and 2, and the NASDAQ, which is a higher risk set of equities, were up at number 3. This was starting to look good. I was hopeful. Now, as of this last Friday, December 16th, where are we? Well, if you look at this, we have a very healthy treasury market still. Long-term treasuries ranked 1 and 2. Gold, which is a safe haven in some situations, ranked number 3. But now equities are absolutely terrible. The riskiest equities, small caps and NASDAQ, ranked dead last. This is not a healthy stock market. And how does this show up in the buying and selling pressure? Well, you can see for the Dow Jones Industrial Average, we had a very nice buying pressure here. This gray line was above the selling pressure for quite a while. And you can see the index was moving higher, including back here where it was above. But more recently, the selling pressure has moved above the buying pressure, and you can see the downward pressure on the price of the Dow Jones Industrial Average. This doesn't look good. What about the S&P 500? Very similar picture, although the Dow was leading the way out, which again is not an indication of a healthy rally coming out of a bottom. But the S&P 500 had a sort of ragged rally here, but more recently the selling pressure has moved above the buying pressure, and you can see the downward direction of the price movement. What about the NASDAQ 100? Very similar picture. We had some buying attempts here, some buying attempts here, and now we're into selling territory again. Russell Small Cap, again, same picture. Although these led the way out along with the Dow, led the way out of the bottom way back in September. You can see that here in the early buying pressure being well above the selling pressure. Tried it again here, tried again here, and now it's failing, and you can see the price declining. And then let's look at Ark Innovation. Now, why Ark Innovation? Well, because these are probably the riskiest basket of stocks out there, at least from the stock market's perspective. And you can see that the price has kind of gone sideways to nowhere over this entire time frame. There have been some attempts at rallies here like this and this, but now the selling pressure is well above the buying pressure, and we have a fairly good decline in prices here. Now let's look at the best sector rankings. These look over a longer time frame, so they're not going to act as quickly as equity versus safety, but they do give you a sense of what's going on in the market. And for those of you who haven't seen my previous videos, you'll notice I'll talk about this being ranked 1, 2, 3, 4. But if you look at the rankings, they go 1, 3, 4, 7. That's because in the model, there are 3 of each of these components. And we discount 2 of them by 1 and 2 standard deviations. So ITA could very well be ranked 1, 2, and 3 right now. But it's not actually, because healthcare is ranked 3. So ITA could be ranked 1, 2, and may call it 5, I don't know. But anyway, you get the idea. So right now, aerospace and defense ranked number 1. In fact, we put this into our client's portfolio a couple of weeks ago. Healthcare ranked number 2. Energy, which was ranked number 1, is now number 3, and I think falling. But what bothers me about this is gold and cash are up here at 4 and 5. And look at treasuries. So treasuries are at 11, 12, 13. So the fact that they're in this top bucket and potentially moving higher is not good for the health of the stock market. And you can also see consumer staples, safe haven assets up here. This is not a good picture for a healthy stock market. And what about the bottom ranked sectors? Well, if we look over here, Bitcoin ranked dead last, innovation second to last, clean energy near the bottom, consumer discretionary, no surprise here if people think a recession's coming, consumer discretionary is 4th from the bottom, and so on. And you can see the technology, the Qs, QQQ, are ranked down here near the bottom, small caps near the bottom, and so on. So this is not a healthy stock market right now. Let's take a look at treasuries, because how treasuries are acting can tell you how people are moving into safety and also what the markets think about what the Fed is doing. These are what I call intermediate treasuries. So 3 to 7 year duration falls into an intermediate category. And you can see that they had a big boost in buying pressure back here, and there was a rally that followed. Another attempted rally here where the buying pressure was above the selling pressure. It's been falling lately, but the price is still going up. So the markets are putting their money back into treasuries after a year of falling treasury prices. What if we go out a little bit longer to what I call intermediate to long treasuries, 7 to 10 year duration? Well, you can see here, these started the big rally later than the intermediate treasuries. So the market was moving toward longer duration here. And you can see that they've sort of flat topped here a little bit, but the buying pressure is above the selling pressure, even though they fell a little bit on Friday. And what about long bonds, the 20-year treasuries? These are the highest risk and the longest duration treasuries that we look at anyway. I'm not going to plot the oscillators for EDV, which are even longer than this. You can see that the buying pressure has been above the selling pressure since way back here in early to mid-November, and the price has had a very, very nice rally here. this could be a signal that the bond markets think the Fed is going to eventually moderate its tightening, and that bonds are the bargain of the century right now because they've been so beaten up and they're likely to go higher next year. And what about gold? Now, I'm not a fan of gold. It's a very tough trade. It's not correlated to anything, and it acts one way in one situation and another way in a somewhat similar but different situation. So it's a really tough thing to make money on. But you can see back here, buying pressure went well above the selling pressure. There was quite a rally here, and then it really moderated here. Still moving higher, but at a much more moderate slope. And you can see that the buying pressure is currently above the selling pressure, except they just crossed over here, and who knows where this is going to go. So I'm not a fan of gold, but if you are, maybe you can get some information out of this that's useful for you. Well, what about Bitcoin and cryptos in general? You can see back here we had a big drop because of the FTX fallout. So the market didn't like the fact that maybe there's more risk there, at least in the trading exchanges, not in the cryptos themselves, than people had originally imagined. And since that time, the price has just kind of meandered downward here. Now, I don't think that it's continuing downward because of the FTX fallout at this point, although there still are unknown risks out there. There are other exchanges that could have bad actors in them. But this is a risk asset. It's not a replacement for gold. It's not anything but a high-risk asset at this point. It's a technology. And technology stocks are getting beat up, as you saw with Ark Innovation, and cryptos are no different. So this is going to continue to probably move lower until we see a healthy stock market, a healthy investment theme toward risk and away from safety, but we're not there yet. So why have the markets been performing so poorly over this last year? Well, most analysts use value-based models to determine if stocks are expensive or if they're cheap. Now, how do these work? So in simple terms, a company's value is equal to its cash flows, and we won't get into the details of what those mean, divided by the current interest rates. So if the interest rates are in the denominator, come on, go back to your math days. If interest rates go up, then the calculated value of the companies goes down. While this makes logical sense, it doesn't consider what the markets might be willing to pay for these companies, either now or in the future. So why does this method of calculating a company's value matter? Because the big money institutions use this method to determine if stocks are fairly priced or not. So why does the market keep going down? Well, until these big institutions finish selling everything they think is overvalued or at risk, the market is going to continue to drop. By the way, these same large institutions have proprietary trading desks where they try to make money whether the stock market's going up or the stock market's going down. Is it just possible these large institutions have a conflict of interest where they will profit if the markets continue to fall further? Would it help them to project a 20% decline in the market soon? Nah, nobody would ever do that. Look, the current reality is that until the Fed pivots by indicating that they're done raising rates, and in fact, even better, that maybe they're going to start moderating the rates and pulling back on them a little bit, and the large institutions make their profits from falling markets, the stock, bond, gold, and crypto markets could be in for a very rough ride. I'm Calvin Rose, and thank you for watching Invest Smarter today. That's all for now.